All right, let me ask you something. Imagine a company that's selling more products than ever before, but is somehow losing more money than ever before. Well, that's not a riddle. It's the bizarre, real-life story of AeroVironment, a defense tech company that is on an absolutely wild ride. Today, we're going to unravel the very messy math behind their head-scratching headlines.
So, here it is, the central paradox that has Wall Street completely captivated. Sales are up a mind-blowing 151%, and yet, the company reported a loss of over $17 million. I mean, how is that even possible? How can a company with sales that are absolutely exploding end up in the red? That is the mystery we are diving into today.
You know, the key to understanding those wild numbers lies in this massive transformation that's happening inside the company right now. AeroVironment isn't just getting bigger, it is fundamentally reinventing itself. And that's where this story gets really, really interesting.
For the longest time, AeroVironment, or AAVA if you follow the stock, was kind of known as the little drone company that could. But they are clearly not satisfied with being a niche player anymore. No way. They are making a massive play to become what's called a defense tech prime, which basically means they're going head-to-head with the giants of the industry. It's a true David versus Goliath story, but, you know, with billions of dollars on the line.
And this right here, this is their Goliath-sized move. A $4.1 billion acquisition of a company called BlueHalo. Now, this isn't just about getting bigger. It's a huge strategic leap to get their hands on critical new tech, everything from advanced laser weapons to space systems. It is a bet-the-company kind of move, designed to instantly scale them up and totally redefine their role in the world of modern warfare.
Now, before we get into all the merger madness, you got to understand the secret sauce to AVAV's original success, the classic razor and blade model. Think of their famous Switchblade drone as the blade. Once it's used, it's gone. It's a one-and-done product. That means there's a constant stream of repeat business because the military has to keep buying more. It's a brilliant, brilliant business model that basically prints money.
Okay, so if you're a bull on this company, if you're an optimist, your argument is actually pretty simple. It is all about the growth. And honestly, when you look at the top-line numbers, it is incredibly hard to argue with that.
I mean, just look at that chart. That isn't a jump. That's a rocket launch. Revenue skyrocketed 151% in a single year, mostly because of that BlueHalo acquisition. We are talking about a company that has more than doubled its size practically overnight. It's just staggering.
And the bulls will immediately point out that this isn't just some one-time fluke. The company is sitting on a $1.1 billion backlog. Now, what that means is they have a guaranteed pipeline of paid work for years to come. It's the ultimate safety net for a company that's in this kind of hyper-growth phase.
And this number is maybe the biggest sign that the company is on a serious hot streak. A book-to-bill ratio of 2.9. It means that for every $1 of product they actually delivered and sold, they booked almost $3 of new orders. They literally can't build things fast enough to keep up with demand. It's a fantastic problem to have if you're a bull.
But of course, there is always another side to the story. So let's flip the coin and look at the bear case. Because once you dig just one layer beneath those amazing sales numbers, the picture gets, well, it gets really complicated. It becomes a story of very, very messy math.
Okay, so get this. After all that incredible off-the-charts growth, the company somehow managed to lose over $17 million on the bottom line. It's the kind of number that just makes you stop and go, wait, what? How on earth does that happen? Let's break it down.
So the main culprit for that loss is a kind of quirky accounting rule called purchase accounting amortization. The best way to think about it is like this. When you buy a brand new car, it starts losing value, depreciating the second you drive it off the lot, right? It's the same idea here. AAV has to write down the value of the intangible things they bought from BlueHalo, like their patents and technology. It is not a real cash loss, but it's a massive expense on paper, and it was big enough to turn what would have been a profit into a loss.
I love this quote from an analyst report because it just perfectly captures the challenge they're facing. Trying to integrate a company this large is like a snake trying to swallow an alligator. It's a fantastic visual, right? The process is inherently messy, it's expensive, and as the numbers prove, it is creating these confusing short-term paper losses that make it really hard to see the company's true performance.
And all of this brings us to the real million-dollar question for anyone looking at AVAV right now, what I'm calling the margin paradox. Yeah, sure, they're selling more stuff than ever, but are they actually making less money on each individual sale? That's the question that keeps the bears up at night.
And wow, this slide really tells the story. Before the merger, AVAV was a high-profit machine with fantastic 39% gross margins. After the merger, that number has absolutely cratered down to 22%. The problem is that BlueHalo's business includes a lot more lower-margin services. So the huge question is this drop just a temporary hiccup while they merge, or has AVAV permanently become a less profitable company? The answer to that could make or break the stock.
So, let's just put it all together on one screen for a reality check. You've got this extreme, undeniable growth in sales. At the same time, you've got a shocking accounting loss, driven mostly by those merger costs. And then you have years of job security locked in with that giant backlog. It is a perfect example of how one single financial report can tell two completely different and equally valid stories.
So, where does AVAV go from here? Well, it really all comes down to a massive gamble. Management is basically asking investors to ignore the messy numbers for now and just trust their vision for the future. It's a really high-stakes bet, with billions of dollars on the table.
And here's what they're promising to do. They're aiming for $2 billion in revenue, to fully integrate BlueHalo, and, this is the big one, to get those juicy gross margins back up into the high 30s. It's a really bold vision, but as any investor knows, promises are easy. Execution is the hard part.
Which leaves us right here, with a final, multi-billion-dollar question. This company is successfully capturing record sales by planting itself right at the center of modern warfare. But with all this messy accounting and those shrinking profit margins, will this massive, expensive bet on the future actually pay off for its shareholders? Honestly, only time is going to tell.
And of course, before we wrap up, just a quick but important reminder, this has been a deep dive for informational purposes, but it is not financial advice. Investing is always risky, so please do your own due diligence before making any decisions with your money.